Hi there, I'm Mike O'Connor, and welcome to Stock Cheat Sheets. You can subscribe to our free data service at stockcheatsheets.substack.com. I put out two reports. One is a relative strength report. The other is a trading signals report, and both are available free of charge on ETFs. We do have a premium section, but listen, earn my business first by watching the relative strength and trading signals on ETFs first. And then if you like what you see, feel free to dive into stocks, okay? But the main point of cheat sheets is to give you a directional edge over other traders. I combine a couple of proprietary indicators with some universally accepted indicators and really a set of best practices that allow us to trade without fear, okay? And so there's basically two parts to what we do. The first part is, I always like to refer to it as studying where the puck is going. That's relative strength analysis. That's where we're not looking necessarily at absolute price, but rather looking at how price is moving relative to other key assets, because that can be a tell. The big institutions, the ones with billions or at least hundreds of millions to put to work in the markets, they are the market, right? We're just little minnows following those big whales, and how they determine their allocations really determines how the market goes. The market is a supply and demand system. There's a limited supply of securities, and institutions will gobble up what is in favor with them, and they will sell the stuff that they think is overvalued or not likely to grow in the future. And our job as minnows is to try to do as many different types of forensic analysis, studying the behavior of the whales in order to gain an advantage over other traders who may be more reactive. And that's where relative strength cheat sheets come in. So what you're looking at here is the relative strength cheat sheet for the major indexes. And I'm going to just expand this a hair. There you go. And so what you're looking at is relative price performance, everything correlated on these sheets to the SPY. The indicator I'm using is something called RSMK. It's just it's some guy's name, and he invented a pretty good relative strength index that allows us to not only rank how stocks are doing relative to one another, but this indicator also will give you an idea of magnitude of performance. What you're looking at here is essentially that RSMK score for each of these major index ETFs. And there's several stock ETFs and a couple of bond ETFs that really do represent the biggest indexes around the world. And what we're looking for is relative price movement. And we try to capture the stuff that's moving the most aggressively against the benchmark, SPY, and the stuff that's maybe declining or moving the least aggressively against the benchmark. And by looking at that relative performance, we can kind of figure out where institutions are beginning to put their money. So unlike you and I with small trading accounts, maybe we have, $1,000, $2,000 to put to work on a trade, maybe 10,000. We don't want to lose that much money, but we're small players, and the shares that we buy and sell, or the option contracts we buy or sell, very unlikely to move the market unless we're dealing with a really illiquid, penny stock that no one trades, right? But institutions, they're fearful of moving the market, right? Because it takes them a while to deploy all the capital that they want to put into a position to work. And generally, they're not just buying a single position. They're buying a set of stocks within a particular sector or industry group, and their trading desk doesn't like to overpay. So there's a method to their madness, and it's very different than our method, but it basically involves sneaking into a position, procuring as many shares as possible without elevating the price. They don't want to trade against themselves, okay? And what relative strength analysis allows us to do is to kind of out them. We can kind of see how they're sneaking in. Now, obviously, with the major indexes trading tens of millions of shares, these are the ETFs that trade hands. There's it's less about forensic analysis and more understanding kind of where what indexes are in favor, rotating into favor, and what are rotating out of favor. So the best way to read this is, well, start with the far right column. This has nothing to do with relative strength. This is money flow. On my trading signals cheat sheets, I'll refer to this as buying pressure, all right? And in general, A green light, just to keep this really simple, a green light means that a stock is under accumulation. Now, for those of you who would like a little bit more than green light, red light, I can tell you that above zero point 0.2, right now, these readings, this is an indicator called the Chaikin money flow. It's a standard indicator you'll find anywhere. Generally speaking, above 0 0.2 is very significant buying pressure for a stock. It means that the stock is more likely trading at its high for the day and trading at high volume. So not only is it closing near its high price, but the volume toward the end of the day when it's at its highest price tends to be better. Now, of course, this is a 21-day average of that volume price analysis. And so you're going to get an average that doesn't fluctuate a whole hell of a lot from day to day. And so it's really about sort of how long and persistent that money flow number lasts. That can be as important as the absolute reading. And so we are capturing a snapshot only here. So for 21 days, for something to be in the 0.3s, that is about as significant a rally as we see. And typically it's the sort of people piling in at a bottom rally, because you have kind of two types of investors, right? You have the ones who think the all clear has been sounded, and so they feel like this is the opportunity, this is the bottom, let's put some money to work, and stock prices go aggressively higher. Now there's a second camp. They're the bears who are short the market, who get spooked out by the amount that price has moved to the upside. And this past week is definitely an example of that. And so they're busy short covering. That is, they've borrowed stocks, betting on the price to go down. And now they realize they're on the hook for borrowed stock that they've borrowed at a certain price that they have to then buy back at a much higher price. They start panicking and they do what's called cover their shorts. It's called a short squeeze. And that's likely what we're seeing. So we're not just seeing bulls, but we're seeing shorts that are like, oh my God, get me the hell out. All right. So what are some of the clues that we're possibly in a turnaround that has some legs? Well, the first thing I would do is you look at money flow and you realize that it's all the stock indexes that have significant buying pressure to the upside. And it is the two bond indexes that I'm showing here, which is short-term, intermediate-term Treasury, 7 to 10 years. It's kind of where the Fed does its interest rate tweaking. And then we have longer form bonds that is the 20 year. So this is the TLT, the 20-year Treasury bond, and then the IEF 7 to 10 year Treasury notes. And both are under liquidation. And as I mentioned, that above a 0.2 is a serious amount of accumulation. Below a negative 0.2, below negative 0.2 is serious distribution. You don't normally see numbers like this for indexes. So these are extremes in both directions. Okay, so that's the first kind of thing. Then the second thing is we have the actual trend. This isn't relative strength. This is actual strength. So the trend in the markets, and I'm using the 5 versus the 20-day exponential moving average to define the short-term time frame. Basically, it's up or green or bullish when the 5 is above the 20 EMA for any particular instrument. For an intermediate uptrend, I've chosen the 1040 exponential moving average pair. Now that for some people might be a little bit short term. For me and my style of trading, which is again a few weeks to a few months where I'm following a trend, an intermediate trend, the 1040 is my sweet spot. So that simply means that the average price of the stock over the past 10 days is higher than the average price of the stock over the past 40 days. So 10 above 40 EMA bullish, 10 below 40 EMA bearish. And then we have the longest term time frame for my sake. I call this my parent time frame. If I'm trading in this time frame, I like to look one time frame below me and one time frame above me, and this is the 1040 weekly moving average pair. Okay, so that's actual trend. And you can see, with the exception of international stock funds, this is the EFA, this is developed Western stock markets, ex-US. So everything but the US. So it's going to be your Japan, your European capitals, Australia, like that. So it's Europe, Far East, and Australia. Okay. And then we have EEM, emerging markets. That's going to be like, well, it used to be Russia. I don't know if Russia's involved anymore in the EEM, but it's going to be your Brazils, and other developing economies here. And so you'll notice that we have not rotated into strength yet, at least as defined by the intermediate trend. It is clearly the US, small caps, NASDAQ, the Qs, and Dow, mega caps, and along with bonds. So the fact is that while bonds are under liquidation, the fact is that bonds are actually in an intermediate uptrend, at least the IEF, 7 to 10 year, and the 20 year. The notes and the bonds are up in 2 time frames. Everything is down in the long term. So right now we're either a market in transition or we're a market consolidating, getting ready for a new low as defined by stocks, most likely. Okay, so if interest rates go down in the long term, bonds should go up, and that would happen in a recessionary environment. All right. So the other thing to pay attention to is I rank everything basically in the shortest look back period, the 10-day look back period, which is a very insignificant look back period. The reason I do that is because we want to read from left to right here. We want to look for trends. We want to see if something is picking up in strength or losing strength. And we're particularly interested in that trend extending out to what I refer to as the sweet spot. So relative strength can fluctuate dramatically from day to day, even from week to week. You know, certain stocks will run up, and again, ETF stocks are kind of the same thing here in this case, but certain ETFs might run up in price for a week and have a really big week. They're up 2%, and then the next week they're digesting gains and they might give back 0.5%. And you'll see that in terms of the relative performance of each of these index ETFs against the overall S&P 500, the benchmark ETF here, the SPY. But when you see persistent relative strength rank out to what is the 3 to 6 month time frame, or 60 to 120 trading days, we don't count the weekends, so 5 trading days in a week, 4 trading weeks in a month typically. That would be, you know, that would be your or 5 trading days in a week and 4 weeks in a month. Typically 20 trading days is a month, and 60 trading days, give or take, is a quarter or 3 months. So that's how we're kind of looking at it. 3 to 6 months, this sweet spot is important. So remember, what this is about is the rank, how price is increasing or decreasing relative to the benchmark. And then we stack rank all of these. So basically, by extension, we're able to compare the relative strength of each of these ETFs against one another. Another way to look at this is you have, if price is speed, then relative strength is velocity, or acceleration, deceleration, right? In order to get to 55-mile-an-hour cruising speed, if you're at 20 miles an hour, you have to what? Put your foot on the gas and accelerate. You might actually be going faster per, for the 10 to 15 seconds it takes to catch up with the rest of the traffic than you would be once you, or you'd be accelerating, I should say, at a faster rate than people cruising who are already at 55 miles an hour. And so that's what we mean by relative strength. It is the relative acceleration or deceleration against overall traffic patterns, okay? So the SPY will always have a baseline score of 0. Anything that has a positive number in the RSMK figure, which you don't see here, means we have outperformance and the rank will be higher. And anything slower than the SPY, that is to have an RSMK score lower than SPY, will be a negative. And then we stack rank these, not in terms of negative and positive numbers, but in terms of the absolute rank of this. So the way to read this is that in the last 10 days, the IWM, which is the Russell 2000 small cap stock index, has been, are we going up or down in price? Well, lately we've been going up in price, has been increasing in price at a faster rate in comparison to SPY. That is the general stock market. In other words, it's been outperforming in the last 10 days. The Qs have also been outperforming the SPY in the last 10 days. They're second ranked, in fact, in the stack of ETFs. Now, just because the EFA has a 4 against the SPY's 3, does this mean that the EFA is going down in price? It does not. It could mean that, but it doesn't in this case. We know that it doesn't because the 5 is above the 20, the short-term time frame, the last 10 days that we've been going up in price. However, we just haven't been going up as fast, right? We're accelerating here, but we're just not accelerating at the same rate as the market. Okay. Now, sometimes the market could be going down, and for example, the FA could be going down more. That would be another version of underperformance. You could have a very similar relative strength rank in a down market. Okay. And that's what we mean by an absolute rank versus a relative strength rank. What we're looking at here is price movement. And then we're basically at a specific look back period. We're comparing price 10 days ago to price now. And then we're comparing how that price has changed relative to all other, in this case, ETFs in the stack that we're curating. I refer to these, my cheat sheets, as stacks, by the way. All right. So that's the absolute rank of relative strength in any given look back period. Okay. You know, the way to interpret the one here would be if we look at price today and we compare it to price 160 days ago, and we compare the changes in price, IWM versus the Qs versus the SPY, you'll see it's telling a different story. In the last 160 days, whether we've gone up or down, we don't know yet, but we can tell you that the magnitude of price change has been either more dramatic if we're going up than either the IWM or the Qs, or in the case of everything going down over the past 160 days, the SPY has gone down less than either of these. Okay, so it's relative performance on a relative basis, no matter what the absolute performance is stronger. Okay, so obviously this is a change, right? We've had a flip-flop here where the stuff that was weaker relative to the SPY is now in this time frame stronger. Now, what we'd like to do is kind of scan the horizon and go from left to right and see if we can find a pattern, something that's picking up relative strength, meaning it's very likely falling into favor. It could be that institutions are sneaking into it if it was a particular stock or more narrow ETF. In this case, we just look at the investment community overall. What is rotating into favor? What is falling out of favor? So very clearly, the Russell 2000, and again, this is a 1, 2, 3, 4, 5, 6, 7, 8, 9 instrument stack. Okay. So the Russell never got worse than about 5th in rank, but obviously it's improved here in the last 100 days from 5th to 1st. It is gaining relative strength, and likely that means it's catching the interest of institutional investors who are preferring this one and voting with their dollars compared to, for example, and I'm looking for something that's falling out of favor, DIA mega caps. Notice mega caps were pretty strong on a relative basis here, but lately have been falling out of favor. Now, one reason for that is that although things have changed in the last few trading days, the dollar has been particularly strong this year. And strong dollars means that large mega caps that have a lot of earnings overseas have to repatriate those earnings and basically buy more expensive dollars with lower valued currencies. So that's a bit of a headwind to their profits, and institutions will recognize that. And that's why, for example, they probably prefer less in a strong dollar environment mega caps that are repatriating a lot of overseas profits into more expensive dollars and losing money in the process, compared to stocks that don't have that headwind, that just book the profits straight here. It's dollar earned in the US is worth $1 because it didn't have to go through currency exchange. Now, another stock index that had been losing strength really through an extended period that began last, November, December of last year. But you can see it here, underperforming as interest rates were heading higher. Technology stocks in the Qs, they do not like high interest rates. Lots of lease equipment, lots of longer term contracts for big technology projects. And when money gets more expensive, corporations have less to commit into capital goods. And the tech industry is very capital intensive. And software intensive too. It's human intensive, but it's also capital intensive. And so the Qs have been underperforming. But lately, remember what I talked to you about interest rates, even though the Fed has been hiking, the bond market has basically been in the interest rates, at least, have been in retreat for almost 2 months now, and the Qs, for other reasons, has rotated back into favor here in the last 60 trading days, moving from 6th rank to 2nd rank. So tech on the incline again after a really steep sell-off that was probably the most beaten up sector, and small caps, which are economically sensitive. And so those are two clues that this may be more than just a bear market rally, right? Because now the stuff that's the most beaten up has recovered the most. Yes, that's very indicative of a bear market rally. But the other way to look at this would be the markets are a forward discounting mechanism. The first 2 quarters of GDP were negative. We had all sorts of supply chain disruptions and inflation that caused consumers to really change their behavior. But since then, interest rates have in real terms come down a little bit. And so fuel prices and energy costs. So things are looking better. And it could be that investors are more comfortable with investing. Now, until this trend change happens, we probably can't make that argument fully. We still have to be, I think, a little skeptical. But that's how to interpret relative strength sheets. Now, the most important time frame is the 3 to 6 months. So one of the first places your eyes should go is here, and recognize that mega caps and shorter term bonds are in most favor. And what's weakest is technology, developed markets outside of the US, and treasuries, 20-year treasuries. So what's up with that? So overall rising interest rate environment and not a very good stock market environment. But then you compare what's been happening lately to that, and you get a sense that rotation might be occurring. And the time to really pay attention to rotation is once we get into the sweet spot. So when we start to see more green that starts over here, trail into the sweet spot section where we move, where we've transitioned now from yellow 5 to green 3, 4, 3, and we've been since improving. It shows that the relative strength rotation is now within our sweet spot, and we do need to take small caps seriously. The combination of money flow, trend, which is a recent change, by the way, this 1040 moving average cross, that just happened this week, and the relative strength movement, which has actually been in play for a while now. And that's the final point I want to make, is typically relative strength transition into the sweet spot happens before trends change. In other words, the buyable trends that I care most about as a trend follower, the 1040 daily and weekly. And so this is what we mean by kind of anticipating where the puck is going, is when we start to see relative strength transition into favor within our sweet spot, we can get more excited about these as that we're trading in the same direction as institutions. All right. So right now, institutions favoring small caps. We're just outside our sweet spot with technology, and we're at resistance. So this is going to be a big week coming up. But if the Qs can continue to outperform, we should start seeing those onesies, twosies transition into our sweet spot. We're on hold for right now. The Russell looks better than the Qs for that reason. Now, we have not yet seen any kind of stock market rotation outside of the US. Most of those countries are behind the US in terms of rates, and are playing behind the US in terms of the economic cycle. They're also weaker. The euro is devastating right now, especially compared to the dollar. Think about having to purchase energy in dollar terms when your currency has lost, about 30% of its value against the dollar in the last year or two. It's been a nightmare. So not only are energy costs increasing for the Europeans, but the cost, because energy is priced in dollars, which is the world's reserve currency, the Europeans are taking a double hit because they're having to convert euros into dollars and then buying energy, which is already moving up in price, though we have all gotten a little bit of relief here in the last couple of months. All right, so that was a major long explanation of relative strength. But you can go through that exercise for most of the other cheat sheets here. So for example, this is now a cheat sheet, and I sent these to you to your inbox yesterday. You can click the links at the bottom of the note that I sent out yesterday, right down here, and you can get at all of these relative strength cheat sheets. I'll just show you another reason why I think that the market is in for a little bit more of a sustainable trend is look at the types of bonds here. though it's very early. And again, remember, we don't take rotation seriously until it gets out into here, but we can at least start paying attention. The last 3 weeks, notice that junk and high yield is starting to make a move off a bottom. We'll see if it lasts, right? We don't do anything. We don't get too excited yet. Trend has even caught up with this. This is one of those cases where the trend is maybe even ahead of the relative strength, just because everything is screaming higher. Now, Treasury inflation protected securities had been moving lower in relative strength. We've got a slight tick up. Don't know what that's all about, but I generally discount 1 to 2 weeks for the most part. Now, 3 weeks start to get a little bit more serious. So 12 to 8, 12 to 11 to 7 on junk and high yield. Now, the fact that it's gone 12, 8, 4, 11, 7, 3, that is interesting. We just need to wait and see. But if junk and high yield catch up with stocks, that's further kind of another data point, another box you can check that says, hey, maybe there's something more to this market than a simple rip to the upside that institutions are going to start shorting here once we hit a major pocket of resistance. Now, what else is going down? Again, it's a little early, but municipal bonds struggling a little bit. Short term, this is the part of the yield curve the Fed plays here. This has been moving lower now for a while, and interest rates higher, obviously. And this is the dollar. I mentioned this, that the dollar had been persistently strong up until about 30 days ago. Again, we have not gotten into our sweet spot yet. It's not that serious until it happens. IEF, the 7 to 10 year Treasury note, rotating from kind of a defensive area, right, of top half to top quintile to, we've fallen out of favor a little bit here. That's something to pay attention to, that interest rates may be starting to go on the rise again as bonds fall out of favor. We'll have to see. But nothing too definitive here yet. All right. So until we know better, it's still a risk-off market in real terms based on the 3 to 6 month, although we're obviously trading a market that's ripping to the upside right now. These relative positions, bonds versus stocks, would have to change quite a bit before we be confident that the bear market is over. All right. So let's move on to the other. Okay, let me do one more. So relative strength rotation within US sectors. This is probably one of the most valuable cheat sheets that we have. So you'll see that energy up until about a month and a half ago was really driving inflation. The war in Ukraine, the lack of energy output in the U.S., Biden having to go to Saudi Arabia to beg for more oil for the world to help him with his foreign policy against Russia. All of that played out. But what ended up happening is the world economy started slowing down and energy prices softened. Now, we're not yet to the point where we can say we're out of the woods with energy prices, right? We do have a pretty significant intermediate pullback where we're now down on energy stocks. They've rebounded slightly in the past 3 weeks. This story is yet to be written. This could be nothing more than longer term intermediate consolidation before we start ripping to the upside. And obviously, these are companies that benefit from rising energy prices. These are not this is not raw commodity. Now, the consumer, that's interesting as well. The consumer got hammered by inflation, but the stock market seems to be discounting a recovering consumer. Jobs are still open by 2 to 1 openings versus people filling them ratio right now. And so we have not. So if the recession is coming, we haven't seen it yet in terms of significant unemployment data yet. And we've been rotating back into favor, not yet in our sweet spot, but darn close. Now, industrials, that's also begun to rotate favorably. Tech has actually moved to our sweet spot. We mentioned that with the Qs. Basic materials, part of the commodities complex, not yet, which is actually a good thing, right? To have commodities out of favor and miners and other materials harvesters out of favor, because commodity is an inflation gauge, and to have commodity prices in retreat is a good thing for consumers. And real estate prices all over the map, right? Rising interest rates on one hand, but not enough housing on the other hand, and still people seem to be able to afford higher interest rates so far. We'll see if the housing market collapses. And remember, if you can't buy a house, you have to rent. So there's a lot of reasons for real estate to remain in favor, even if the housing market itself collapses. Now, in terms of things that are falling out of favor, utilities had a big week last week. Let me show you here. Utilities actually broke out of diagonal resistance and may be starting to run again. But in terms of relative strength, a little bit softer than the rest of the markets. Communications, another kind of weird, this is a weird hybrid between media stocks like Facebook and Google and cable and satellite radio and so forth, but also good old-fashioned telecom stocks like AT&T and Verizon, like people that or companies that deal with even old-fashioned landlines are here. So this used to be considered a defensive part of the market. Now, I don't know, it's just completely out of favor and not moving at all. Consumer staples, a defensive part of the market. Now, it too had a pretty big week last week, but not as big as the rest of the market. So another example where we're fading from a relative strength perspective, though you'd never pick that up based on price. You see how you can get fooled here? This is a pretty big breakout, a moving average cross. Same thing with what we just looked at with utilities. And my guess is healthcare, again, falling out of bed from a relative strength standpoint, even though it looks pretty healthy from a price standpoint. Yep, moving average cross moved higher. So if you don't look at the relative strength reports, you sort of miss the trend here that we've trended toward risk on, meaning more cyclical, high beta parts of the economy, and the more defensive, dividend paying, higher yield, safer, lower beta, meaning they don't fluctuate as much. Now, it's only been a couple of weeks, 3 weeks, but they're falling out of favor. So it's a trend we need to start respecting, especially like XLP up here, where the relative strength trend is unmistakable in the past 80 days within our sweet spot, going from second to sixth, eighth, and then down big, but then recovered. But overall now double digits rank, yet it's still in an uptrend. But this is an area that's cooling. So when you have healthcare, staples, and utilities all cooling from a relative strength standpoint, that tends to front run price. Now, does it mean that these areas of the market are going down? No. In fact, when the market gets bullish and kind of everything is running, these tend to go up in price along with the rest of the market. They just don't go up nearly as much, right? So people defensively positioned tend to miss out if they don't have any exposure to more cyclical parts of the economy. Now, the opposite is true if this is just a bear market rally and those who've stayed defensive, once the market starts selling off hard, will feel less pain than the folks who went all in up here. So again, we have a market that's in transition, but subject to failure. Hopefully, you're the type of investor that uses cheat sheets to sort of keep both fingers, one in the warm water, the other in the cold water, and you just sort of constantly managing your investment so that you're sort of moving incrementally along with institutions into kind of one end of the pool or the other. That's possible when you're an active trader. Obviously, when you're just a buy and hold investor, you diversify, hold your nose during the tough times, and say happy days are here again during the good times. But as active investors, we like cheat sheet data. Okay, so that's our kind of where the puck is going data. I'm going to speed things up a little bit, but I just want to spend a little bit of time on helping you interpret cheat sheet data, because I haven't really done that outside the written form in a while. Okay. So what we're going to look here, we'll look at the most liquid stack of ETFs. So these don't necessarily have a particular investing theme. These are just the ones that have the least amount of spread between the bid and the ask price. When I say that they're liquid, you're not going to get hurt as much by trading them in and out as you would say a less liquid stock that has fewer buyers and sellers at any given moment. So the difference between the buy price and the sell price at any given moment can be broader, and it can be harder to deal with liquid stocks. Also, these are the ETFs that are more likely to have options, which is mostly what I do. I trade options. I'm not really speaking in terms of options here, but for those of you who do trade options, this stack is going to be much more welcoming with more liquidity on the option contracts, more open interest, more option contracts traded every day. So millions of shares and lots of option contracts. Now, remember, the most important score, if you don't want to get bogged down in the weeds here with the 10 checklist formula I have for determining the tailwind score, you just go right here, right? Things are stack ranked from worst to first. And basically the line of demarcation is 50%. Now, 50% is barely bullish. It means that when you analyze the factors, you basically get at 51%, slightly more pros than cons. And this is where a trader needs to have a certain set of minimum standards if they're going to execute trades when we're down here at this lowest echelon of bullishness. All right. So when I talk about a sweet spot for stocks is probably more likely the 60s and low 70s. Now, up in the 90s and 100s, we're probably nearing the end of whatever bullish run we've had. So you don't want to wait too long. But in general, 50s would be early. Aggressive, I guess might be a better word, but more gains, right? So the earlier you go in a bullish cycle from bearish to bullish to more bullish to extremely bullish, the earlier you go in that paradigm, the more money you're going to make, but the more risk of failure that you have. And so the 10 checklist formula, the reason I keep it transparent is so that you can make good decisions about what's important to you as an investor or trader. But a lot of people are just like, I just don't want to get bogged down in this. Just tell me what's good or not. Basically, the higher this score, the more likely institutions are along for the ride, buying stocks and buying aggressively at the highest ends of the scale, okay? And this checklist is kind of broken into, I would say, 3, maybe 4 sections. So the first is the real trend. This is sort of like what we just talked about here. Slightly different metrics than on the relative strength cheat sheets, but long-term trend is exactly what it was on cheat sheets relative strength. 10-week moving average above the 40-week moving average will get a bullish score, and that's worth 3 points in terms of the total checklist here. So you get that long-term trend, it can really elevate the tailwind score. 10 is under the 40-week exponential moving average, you're bearish. The intermediate trend is just like it. It's the daily 1040 EMA, just what we just talked about this. And here, the short-term trend for now, though I think I'm going to change this, is the 1040 EMA. This just telling you on an hourly basis. So this is the hourly EMA, daily EMA, weekly EMA. When all three are bullish, you're really screaming to the upside like utilities, despite it not having tremendous relative strength. All right, so next is buying pressure. That's the shake in money flow. To get a 6, very bullish, you have to be above 0.2 in money flow. That is some serious accumulation. And you saw a lot of stocks were in 0.3 and higher. That's like panicking, FOMO buying. And we're seeing that across the board here. A 5 is a very acceptable score above 0.1. And I'm going to have to go here soon. And then we have neutral and bearish. And for me, I definitely like stocks that are bullish or better in this checklist. All right. Then we have buying pressure. I'm sorry, a relative strength. So this is, we're looking now, we're in transition here. We're actually comparing all of these to the Russell 3000 or the ETF IWV. I know I'm saying this is the benchmark, and this is still where this ETF would fit in the context of the rest of these. But the comparative benchmark is in actuality the IWV. So this is how they would rank, but this is how they would rank in comparison to the broader Russell 3000 total market stock index here in the US, okay? So this is the 6-month comparison, and then this is the 3-month comparison. If you want to be at least neutral plus in both, but the better the relative strength, the more of the magnitude of relative strength, the more bullish we are. So this, unlike the relative strength rank cheat sheets, this is where I give you sort of a magnitude. So very bullish means we're seriously outperforming. Bullish means we're solidly outperforming. Neutral plus means we're slightly outperforming. Okay, and the same would be true on the bearish indications. All right, and then we have the market forecast. This is a 4 oscillator indicator that combines multiple time frames to sort of give you different buying signals. Okay, and the most important for bullish traders are these 2 the long-term forecast and the intermediate forecast, we want these as bullish as possible, though not too bullish. Remember, very bullish means we're closer to the end of the beginning of this particular bullish run before potentially an intermediate pullback. But when these are bullish, what you're looking for is pullbacks here, meaning softness here, but that's not too extreme. And when we get that, that's when we get the best signals here. So strength here, and then I would almost argue neutrality, where the shortest term timeframes of stock trading, we're pulling back slightly, but not so aggressively that we're triggering kind of institutional selling. All right, that is the sweet spot for the market. We're going up in the forecast, meaning this is about velocity, not necessarily about speed. Remember the difference here, right? We're increasing in, I guess, velocity is speed. I'm talking about acceleration, right? Acceleration versus velocity. That's what all of these indicators are doing. They're describing price movement in relative terms. So accelerator, accelerator. And what we like to see here is not necessarily accelerator, accelerator here. We'd rather see kind of slowing down and just staying with the traffic, or even slowing down to exit, to slow down so that we can maybe get in the car. I guess I'm mixing my metaphor, but that's the idea here behind a lot of these signals. So I'm going to skip to just two signals today. They are the trend stage progression signals, and you'll see them. Actually, it'll just be one today because all of them are stage 3, and then there's a buy the dip. So let's tackle the stage progression signal, and this will be sort of the last thing we do today. But there'll be more videos, and I'm not going to do it on XLU because we know that that was weakening in relative strength. Let me do this. Let's take a look at. Let's look at SPY. This is a good one to do, right? It's the index. All right, so the SPY. Overall, with the exception of still no bullish trend on the longest term moving averages, a nice solid tailwind score of 62% and a stage 3 very bullish standard trigger. Let me show you what that means, okay? So for those of you who read my blog, you might be reminded about the intermediate stage progression signals being an opportunity to split your total investment into thirds, into tranches, okay? 1/3 tranches. And basically when the market got bullish back here in mid-June, would have been your first opportunity to pick up to invest your first tranche in the market. And that is when we had our first emergence of the intermediate time frame above 20. Okay, I'll call that 20 here. So right here. Now there's two things that are required for an intermediate trend progression signal. We need the green line crossing from, I'm going to use the football analogy here. We're in our own end zone. We recover the ball. We recover the ball on our own 1 yard line. That's what it means to move from below 20 to above 20. Okay, so we're like a football team pinned deep in our own end. However, we have wide receivers open downfield. So we had the trend progression signal happens if and only if the near-term line finishes above 80. When our intermediate line crosses this 20-yard line, okay? So from below 20 to above 20, confirmed by blue line. That's how you get a standard trigger. What is this telling you? It's telling you there's a good chance you're going to be able to get downfield because you've got weapons open downfield. This is swing traders feeling good about their price targets. They're not bailing early, okay? And this means that us as trend traders, we can take a shot with just a 1/3 risk, because remember, down here, much more subject to failure, right? These signals can roll over and price doesn't catch on and it falls back, right? So you just want to put a little money to work here. So that is intermediate stage progression signal number 1, crossing above 20, confirmed by the blue line. Now, the signal is even stronger when on rare occasions, the red line finishes above 90. So if you get that, it's called a strong trigger, okay? So again, green line crosses above 20, confirmed by blue line above 80, and red line above 90. That would be a strong trigger. This is a standard trigger. And this was our first progression. Okay. Where was our second? It's when we moved from below 50 to above 50, right about here, confirmed again by the blue line. You see that? So we moved here and the blue line just kind of basically stayed pinned up here at the highest level of momentum. We are just on that accelerator pedal, right? So we crossed above 50, confirmed by blue, not here. I'm not going to talk about the red line, but the red line staying above 5 is kind of important, which it did do. Yes, it did every time, despite all of the walls of worry here. It looks like we never crossed down below 5. Okay. So that was our second intermediate trend progression signal. Another third. So now we have 2/3 invested. What happened here? Well, this was actually a little bit of a warning sign. We got what's called a divergence. So price went higher, but this blue line actually finished lower. That's a little bit of a warning sign that says things are going to slow down for a little while. And they did slow down or even reverse. Luckily, that didn't happen, right? But we just last week got our third intermediate trend progression signal here and just barely confirmed by the blue line. It's close, but right there it is. Green crossed above 80 this time, confirmed by blue line also above 80, even though it was only just a day. And yes, there's another, well, no, actually there's no divergence here, right? We've had our 3 successive down moves in this oscillator, and then we got a move higher. Okay, so we did get the weakest possible intermediate transition signal above 80, but we got it here. So between here, and here, we're fully invested, right? So now we have all of our capital to work and we're up against resistance. We need this green line to kind of hang out above 80. We need the blue line to get no worse than 20. And it's going to cool back. As long as it stays above 20, we're okay. The trend still is in great shape. And as long as this red line stays above 5. So we are going to get these kind of pull downs here. We just don't want them to be too dramatic. When they are, things can go sideways for a while or even reverse. So that's a little bit about the market forecast. Now, I didn't really mention this line. This line needs to be above 20 for us to feel good and point it up. Okay, so at the very least, we're neutral plus. This line really comes into play once we get above 50. It turns this run into a serious bull run. So right now we are trending up. So we're tepidly bullish. I think we call it neutral plus on the spreadsheet on the long-term forecast, while we're very bullish on the intermediate forecast. And so far, not having any major extreme reversions on the junior timeframes. If we can keep this above 80 and we can get this above 50, then I'm convinced that we've been through our bear market bottom. And that's it. We're lows for the year in. But until that happens, we have resistance here. We have this line not quite above 50. We need to keep an eye on the market and one hand at least on our sell button. All right. I think I've taken enough time. I could go on for hours, but hopefully this has given you a little bit more understanding of at least some of the trading signals. And I'll start doing more of these videos as the days and weeks go on. Thanks for now. Have a great rest of your weekend and happy trading starting on Monday.